Markets flirt with highs of the year as traders still grapple with negative news from the Eurozone. The ADP report this morning could give clues to what will be a very important jobs number on Friday. Facebook is finally planning its roadshow as the official date for the IPO has been set for May 18th. I'm Taylor Schrantz, and the morning call starts right now.
Good morning. I'm Scott Redler, Chief Strategic Officer of T3Live.com.
And I'm Stephanie Link, Director of Research and VP of Strategy at TheStreet, and together we bring you the morning call.
So yesterday we came in, it was the beginning of the month, everyone's like, what do we do this time in May? Do we sell and go away? Are we going to have that same type of pull-in that we usually have between May through the summer so we could reposition in the third quarter? And I think there was a lot of constructive action. It wasn't perfect, but I don't think you could just have an opinion or a bias where I'm not going to be involved in stocks for the next 2-3 months because sell in May always works. Because if something always happens in a particular fashion, typically it changes because Wall Street wants to make as many people feel as bad as possible. So to me, I think you could stay the course, but you have to maneuver. Now I have Stephanie here, which is great because she's been doing a lot of maneuvering herself.
Yeah.
What do you think of what's been going on in the market recently?
You know, I think there's a lot of cross currents happening. You know, earnings have been quite quite good. I know that expectations were lowered, but I actually think that underlying fundamentals, sales and margins have been better than expected. Guidance, appropriately so, has been pretty conservative, which I like. So maybe that sets you up down the road for some surprises. But at the same time, you've got the macro headwinds. We know Europe is decelerating. China seems to be soft landing, but there's question marks certainly. And the U.S., to me, March and April did see a deceleration from January and February. So the question is, was it weather pull-in? Is it really, is it just a slowdown, or is there something more? And I think what most people are thinking now is, you know, in the last 2 years, we really saw May begin the downturn in the markets and in the economy. And so that's why we're all kind of waiting and looking at the data points. And so obviously Friday's number is going to be very important with the non-farm payrolls, and we'll see what happens there.
So I think we get a little glimpse today with ADP, so that'll set the tone. And I think overall, you hit a lot of spots. There are going to be problems in Europe. It feels like there's always going to be problems there. So we're going to have to go through them. And every time we get a headline that we're not used to, maybe we have a pull-in or we have some type of down open, and then we see how we absorb it. And recently, with all the numbers last week, or even the headlines as far as Spain being downgraded, you had Britain double-dip recession. We took it in stride, and our equity markets are hanging in there, and stock selection has been key. There are a few things that I'm a little bit concerned about, but I'm not just throwing in the towel. That's the fact that the market's being led right now by the Dow. If you take a quick look at the chart of the diamonds, DIA, you will see that, you know what, we were at highs here. So there are two things you can look at. One, if you're involved in stocks within this group in the Dow Jones, you're doing well, you're making money, and you have no concerns, and hopefully you're just maneuvering it really well. But what traders like to see is the market led by just say tech, because tech obviously moves very fast, and it shows you that people are looking for growth. And if you look where the Qs closed yesterday, well off the highs, well below these highs, so that's giving you a bit of a divergence, but not anything to say game over, just a little sign that maybe we're not going to be off to the races. A lot of guys are also looking at the Russell. IWM, if you want to take a real close look here yesterday, you will see that it had an outside day, meaning it went to highs, went back below the highs and closed on the lows. So that's a bit of a sell signal. Not game over, just again, don't be all in, be ready to maneuver your portfolio. So at resistance, it wasn't ready, just to keep going. So you have your support. Yes, there was a bit of an outside day. So I think what guys are trying to do, and portfolio managers like Stephanie, are just trying to maneuver positions, have some cash, buy dips, play breakouts, and you can be rewarded, just don't have a bias.
Right, and you know, we actually have a pretty substantial amount of cash right now. We've been taking profits along the way, and we're waiting for a dip if we get one, or just specific stocks. If you get kind of a blow up, unfortunately, we would maybe take a look at some names. But what was interesting to me is that the highest quality blue chip companies are really, they have impressed me during the earnings season. And you know, it's something like a Coke, for example. While I wouldn't buy it here, we've owned it for a while, I was very impressed that they were able to outperform on volumes, get pricing in the face of pretty substantial headwinds in commodity pressures. You're seeing consumer staples fall by the wayside. Look at P&G, look at Kellogg. I mean, these companies are great quality companies, but they can't get the pricing. And so this is one that is on my radar screen to add to. And oh, by the way, they are splitting the stock. That always tends to be very good for performance. So that's one you want to take a look at, I think.
And that goes right into our sector spotlight on big companies that people know that are high quality, that have been supporting the market. That the beauty of having Stephanie on, she's been doing it for a few months with me. She broadens my horizons. I've been trapped in high beta tech land, and ever since you started coming last year, I started looking at materials, I started looking at refiners, I started looking at mega caps, and when I look at the chart of Coke, I'm like, wow, this trades by patterns also. It's not just a great company. If you look here, on the breakout right around 71, that's something a chartist would have been looking at to buy. Then you had a nice move. It corrected, held where it was supposed to, came back. Look how tight this is. This is an exact pattern I look for. Usually get it in tech stocks. This happened with Coca-Cola, and here's your breakout. So I think the reason Stephanie has so much cash is because she's probably taking profits because she's been timing this the right way. So as far as Coca-Cola, I would say I don't think you're going to get a huge pullback, but if you sold some into strength, sometimes you retest an area like you just did, like right here on this move, you've retested 71. So I would say on Coca-Cola, if you're not involved in this one, if it pulls back to the 74 area, I think that's going to be your area to buy it back, and it should stay on the move, especially with that fundamental thesis.
Right, and so then another name that we were talking about is American Express. To me, if you don't have tech and financials lead, that's kind of problematic. But a name like American Express has been a leader, right? I mean, you look at this stock, again, this is not one that I would buy right here. It's just had a nice run. But again, a very good earnings report. And the issue with American Express has always been they're spending too much. They're making a lot of money, but they're spending it, they're plowing it back into their business, which I like to see so that they can grow double-digit earnings for the long term. They're doing that, but this was the first quarter that actually saw positive operating leverage. So their cost came down, and that's exactly what everyone wanted to see, and that's why the stock is breaking out. It's still actually very attractive on a valuation basis. So it's one that I hope, you get a little bit of pullback, and that would be one that we would add to as well. Again, big cap, quality name.
Well, what's good is you were here, I think it was 2 months ago, you started talking American Express. I'm like, my traders are looking at MasterCard, Visa. They're the ones with the high beta. They move fast. And you're like, you know what? I like to look at something on the side that's a little slower that I could accumulate and then play for a breakout. And I'm like, you know what? This looks good. So there's two different ways to play it. You get it while it's in the base. You get your tier 1, and then you get your in motion tier when it goes. And look at something like American Express. It didn't have to be MasterCard and Visa. It performed very well. And if you look here at American Express, this was one area to buy it right around 54. You had a big move. It then corrected, went sideways. I think we were talking about it somewhere in here, buying it versus 56. It held, and then this was your breakout. Look at this even closer. And again, this doesn't look like AXP. It looks like a technical chart breakout, which shows you that it can happen with any stock. It doesn't matter what the symbols are, and if it's quality, more bang for the buck right there. So here you go. Closed at the highs yesterday. If you're an American Express holder, investor, trader, you're doing very well. You don't care that Britain's in a double dip recession right now. At this point, I would say again, if you bought it here, you add it here, you sell some strength. And then if you're not involved, look for a dip, because these things do dip, and that's how you enter. You buy a dip, you play a breakout, you take some off, and American Express has been a great pick.
It's interesting that, though, these two names are kind of indicative of what's happening, again, the broader average. People are rotating, maybe having a more balanced portfolio. For these stocks to be outperforming certainly suggests that people are getting a little bit more defensive because they're not high beta names. So it kind of confirms what we've been saying, right? That you are seeing a bit of a rotation, maybe have a little cash on hand and continue to balance your portfolio.
And another area that you're looking is what? Eaton, ETN.
Yeah, so industrials, that's a hard call, right? I mean, you've had a couple blowups this week. You've had Emerson. Cummins didn't deliver, although it was a good quarter. They didn't guide to where people wanted. Eaton, so you go back 2 weeks ago, they reported, and actually, if you compare all the industrials, these guys actually did a very good job. They beat, they raised, and they talked about how U.S. was actually doing much better and that China and emerging markets were slowing. Not a surprise, but they're able to handle it because they've got such a diversified product and market where they have a lot of U.S. and a little bit of emerging markets, and that's kind of what we like. Great balance sheet, and again, they've raised numbers now twice this year alone. So I like that in an industrial, even though the macro, we have issues about manufacturing and industrials as a whole. Is it decelerating, and where is it going to go? I think these guys can handle it, and I like that dividend yield too.
Well, you can't have everything breaking out at the same time in your portfolio. That's why having it balanced, like I look at this chart, it looks like it's setting up. It's incubating for what could be a better move once things start to align as far as the fundamentals. So if you look here at the stock, here's where I put its peaking, and ever since then, it's been just consolidating, very methodical, going lower. So new buyers are coming in, new institutions. If you want to look even more on a macro level, where it came from, rightly so. From here to the highs, it had a nice methodical pullback to test a recent breakout. So I would say if you want to be in this and you believe in the fundamental thesis, you're in tier 1 in this whole area, above 45, that's the support. And then if it starts getting above, just say this 49 area, that's when you add for motion. That's when people will be probably saying the industrials are doing great, let's go after it. So tier 1 in here, here's your tier 2. Then if it takes out the highs, you sell some strength, just like you could have done in Coca-Cola, American Express. But again, not everything happens at once, so it gives you time to maneuver.
That's right. That's exactly right. And so we're still overweight industrials, but to a lesser degree. And we have been taking some profits in a few different names. Boeing was one also that we've actually been taking some money off the table, and not because we don't like it.
Boeing was a great call, and it shows you different time frames. I got so chopped up in Boeing and had so many false breakouts, and then all of a sudden it went, and I was too tired and I missed it. But Boeing was really good. Boeing, you had, remember this whole big base? I'm just talking about Boeing because you were saying I'm buying it. I'm like, okay, I'm trying to, but I didn't have the patience or the wherewithal. But then, pow, nice breakout, still looks good. I would say Boeing still has another move here. It starts getting above this 78. You're going to see an additional move because if you look at the size of this channel here, the channel was from about 70 to the highs here of about 77. So, it should really get you a move to the low 80s. So I think you take trades along the way, but overall, Boeing at some point this year is going to be well north of 80.
And you always want to buy this stock actually ahead of the Paris Air Show, which is in July. It always trades higher, and then that's when you sell it in July. So I've learned the hard way a couple of times. But
buy the rumor, sell the news.
There you go.
Another Wall Street secret. That means it finally out, it's priced in. People are like, well, the good news came out. Why is it going down? Because it just ran 25% into the news.
That's right.
Anyway, you've also talked Whole Foods, which is one of my favorite places to shop.
Yeah, I know. I wish we had one near me too. We don't, but this is a great quality growth story. It's really not a lot not to like, right? I mean, it's health food, it's organic, it's wellness. Those are themes that are very, very popular, and it's a secular growth story. They've got store growth expansion. They're lowering their costs. They're offering value products. The only thing I don't like, Scott, is that it's 31 times earnings, and that's close to its historical average. So this is one that I say, why not wait for a Starbucks moment where, the high growth names, they have a little bit of a hiccup. This one, if it does have a hiccup, it'd be one that we would definitely take a look at.
Well, right now I'm looking at the chart, and I haven't looked at this one in a while, and it looks very tight. It looks like something's setting up for a momentum move, and that's Whole Foods. If you go take a look here, you'll see it's in a sideways channel. We talk about this is what we like. It's been holding above support here. Support on this thing has been about 80, 81. Yesterday it tried to go, wasn't ready, but if this stock starts getting above this level here, above about 86, you could see a breakout. The stock's above its moving averages. It's technically acting really well. You want to look at it on a macro approach. It's doing well, and it looks like it could break out. If you get your Starbucks moment, that means it's going to be breaking the support, and you could see some downside action. But at this particular point, it's not showing any signs of that yet. And here will be your momentum play above that level for new highs.
And I would also just classify this as a high quality name. Again, it's maybe has a little more beta, maybe a little more expensive than a Coke. Would love to have dividend support, particularly in these times when you have a little uncertainty. It's nice to have that yield, but it's just a quality name that I think again, we'll keep an eye on.
Exactly, and we're going to keep an eye on a lot more stocks once we come back from the commercial break and we take it into the trenches. Stay tuned.
Hi, I'm Sean Hendelman, CEO of T3 Live, where we train, coach, and mentor traders in order to help you put your money to work with confidence. The T3 Live approach is a blueprint for you to recognize, adapt, and ultimately take advantage of different market conditions. To begin your training with T3 Live, we would like to offer you the opportunity to enroll in our free 30-day online home study course. Fill in your name and email address, and I'll see you on the other side.
With another group of stocks that are not exactly the names like the last group, but some that you do, that there will be some opportunities. So I'm going to let's definitely talk about a few that she thinks could come on our radar that we could be watching and maybe entering. First one I think was URI.
Right. So what we've heard now from several companies, industrial companies, is that U.S. is strong and that international, China, emerging markets are weak. Not surprising. But one area in U.S. is non-res construction. That actually has seen a pickup. And a lot of macro data points have supported that too. URI is a rental equipment company. They just bought their #2 largest competitor. And so not only do you get the macro benefits, but you also get these synergies. And I think they are lowballing the synergy expectations. So I know the stock has had a nice move, but it is certainly one that I think you put on your radar screen because there is a secular growth story going on in equipment rental, the market. as these are very expensive machines.
Right.
So it's better to rent than to buy them, and that's why these stocks are doing so well.
And now, are you involved in it, or are you waiting to get involved in it?
No, we're not involved in it. It is certainly one that's on our radar screen. It has been for a while. It just hasn't come down. I think under 40 would be ideal, but it hasn't been there
so
for long.
We'll take a quick look at the chart. This one has been on a tear, obviously, from the $15 range all the way up here. The chart doesn't really look like a great trading vehicle because you don't see some wide range days. But if you're looking to buy a dip, if it were to start to break below this little uptrend here, below this 44, you could get a move to 40. It's also got a huge gap here, a pro gap, which shows you that that people paid up for it and it never was able to come back in. It tested it here and it continued. So I would say, you might not get that moment to buy the dip, but if it starts breaking above this area, you're going to see some momentum. If you're in this stock, it still looks good. If it breaks below this 44 area, I think you could buy your dip right around 40 and make sure that this gap holds, because if this gap doesn't hold, that means it's a complexion change.
Mm-hmm. And then so the next one is also U.S. kind of focused, and that is Stanley Black & Decker. This is a housing play, but 50% of their revenues is kind of do-it-yourself. 15% of their revenues come from Home Depot and Lowe's. And we know that the warm weather and a little better traffic trends have improved. This company did not report the best quarter. Actually, it was a little disappointing. We were buying it on the disappointment because I do think that some of the trends that they're talking about at Home Depot, at Lowe's, at some of their biggest retailers, they've seen a substantial increase in their sales. And there's a lag effect in terms of when these companies then order these products from Stanley Black & Decker. So I think the second and third quarter is going to be better. And it's also, they also have an industrial component that was actually very strong too.
Well, looking at this chart, it looks like it definitely needs time.
Yeah.
So it might need that time to work out. I could see on the chart the day that it probably came out with earnings because you had your gap down. So if you look here, it was trading pretty strong. The earnings were not expected to be a disappointment, came lower. It's been going sideways. If you take a look at this technically, I would say if it starts to break this mini floor that it just put in and breaks that earnings low, the earnings low is 71.42, you could see some more downside action and it could come in and test this 67. If you want to play for the third, fourth quarter and you want to buy a dip, I think the dip to buy would be closer to 67, especially if it starts breaking below the low from that earnings day. So 67, below 70, you start getting excited. Around 67, 68, that's when you buy that dip.
Okay, well, hopefully it doesn't get there.
Oh, so you're in it?
We're in it.
Okay.
We're in it. And I just, as I say, I feel very good about the long term, and I actually also think you're going to get a special dividend, some sort of an announcement about a dividend, and I think that might help the stock. Fingers are crossed.
Well, the next stock is in retail, and retail's actually been leading. Retail has been a place to go. People have been saying for 2 years retail is dead. I just want to quickly show you the chart of the RTHs. The RTHs, like the Dow, is acting very well. Better than tech right now. The RTHs made a new high above the recent high before the Dow even did it yesterday, and now it's holding here. So retail is a place to be. Lots of stocks are doing very well in retail. The RTH high here is about 42.71. If that continues, it's going to go. And the next stock on your list is a bunch of clothing that I like. From Ralph Lauren. I just got Chase a new shirt, and it looks very good on him.
I'm sure it does.
And the chart looks pretty good as well.
Oh, I'm glad. Well, actually, the retailers that we're focusing on, high end, and then also kind of the low end, right? I mean, and that's been the theme for a long time in retail, but it's worked, and I like them. Ralph Lauren actually has such a broad product line, and it's not only is it women's and men, but it's children's, it's high end, it's low end, they're everywhere. And what I like is they're spending $1 billion at improving the company, increasing their retail store base, expanding into China. And I think there is a lot of opportunity in China. I know we've heard that story before, but I don't think people really fully appreciate it. So valuation is trading really in line with its historical range. And again, I think the theme continues to work. So we've been accumulating it.
As long as the people in China don't make the same brand and put it on the street for $1. But anyway,
that's right.
No disrespect. But as far as the chart, this one actually is giving you some signs. If you look here on the chart, it's been a great, methodical move all the way to the upside. If you take a look at this day here, I know this doesn't mean a lot to everyone, but to me, that was a sell signal. Look at that, just to show you how you could time the market. Stock tried to break out, closing the lows, so it couldn't get the momentum. And since then, it's been somewhat correcting to the downside. So if you look here on this day, it filled a big portion of the gap, which took some of the pent-up momentum out of the way, but it still held some of it. So it didn't actually fail there. It held, so the bulls still had some control. And now with this nice upper base, new groups of buyers, profit takers are going, side to side here. So I would say this starts to get above 175. you could see another move to highs here. I would only be in tier 1, and I think traders would start looking for a move above 175 before momentum comes in. And for it to continue to really have this pent-up momentum, it should hold this 170, the upper end of this mini channel. So sideways work here through 175, that's your trade. And then the highs of the year right there was about 182.
Nice. Okay, well, we'll take that actually.
And there you go.
There you go. And so more on the low end would be Dollar General, and I think that again the high end has worked and the low end has worked, and Dollar General has been just a phenomenal company and stock as the company continues to kind of transform itself, offering more products and getting a little better pricing, which I know the consumers aren't going to want to hear, but the company's margins as a result actually have upside, and I think that that's not fully priced in. It's had a nice move, but I think the numbers have upside based on the margin potential, and that's what I like in a retailer.
Well, I look at this chart and I couldn't trade it. Like you look at this, it's like a washing machine. Red day, green day, no continuity. If you take a look here, kind of difficult. Look at this. Yeah. Red, green, red. Like it's just so choppy. And then even up here, you had a bit of a breakout to then just get negated. Okay, start to go here. Look at this potent day. I'm sure shorts got all excited saying, oh, we have an outside reversal. Then yesterday we were up. So I think as an investment, you could buy it and trail it. I would say just, watch this last uptrend here. If it starts to break below the low here of about 47-ish, it could pull back to retest this line. I wouldn't use this as a trading vehicle, as an investment vehicle, as long as it stays above the moving averages. Stay with it because it's just a little bit sloppy. And we don't own it, but it's one that, again, like mid-40s, maybe low 40s is where we would be more aggressive in getting active in the name. Let me take a look one more time. Mid-40s or low 40s. So here would be the mid-40s. So if it breaks this trend, that's when you'll get the low 40s. So the low 40s come in right around here, which was the previous breakout. So I would say it breaks this rising channel, so to speak, or rising uptrend. You could see then 43, but if it goes down to 40, the stock's probably in more trouble than you want to be involved in. But again, so the problems with Walmart might also be beneficial to the low end, and that's why I think these stocks have also done really well, because they're taking share from Walmart and Target and others, and even Costco, which we own, but I don't want to hear that, but that's something, the secular story is there, plus you have some of these other interesting facts that have changed the story as well. Okay, now we're going to switch gears. We're going to go to quick hits. I'm going to try and make them quick. Stephanie, you give them to me. What's the first one? All right, Apple, surprise. Apple, okay. Yesterday gave you a quick bounce early on, and then it showed a relative negative divergence around 10:15, and then again at 12. If you look here at the chart of Apple, it had every reason to go up yesterday, and it didn't. So to me, I'm going to be a little standoffish. I'm going to just use the levels here. The low of 581.73 is important. You also have the 50-day right there. If we break below 580, this stock could be back at 555, so just be a bit cautious, and 581.85 is your pivot. Okay, Schlumberger. Schlumberger added to positions yesterday. It was finally breaking above 74.50. Came off the highs, so a little lack of momentum. I'm still staying with it. I think you like this one also. Yeah, we like it. We sold it at 77. We bought it back at 69, and I think that international pricing story is still very much in play. Well, here you go, just quickly with the chart. I like this one. Look at this downtrend that it tried to bust through. It would have been nicer, from a P&L standpoint if it closed in the highs, but I still think it's okay. As long as it stays, I would say, above this 73 area, I will stay long. Actually, you know what? I'll give it a little bit more room. I'll stay long this thing to about 73, and then hopefully, the oil service sector, which has been getting some love lately and actually trading well with the market, can continue. But it's had a nice move off of the support. I remember you were saying you were buying it right around here. This was buy and support. Well, here's your momentum, and at this particular point, I would just be in a tier 1, not a tier 2 or tier 3. Yeah, we'd probably sell it again at 79. Trade it back, but you buy it in under 70, you sell it in the upper 70s. And right there, just one more time with the chart, so she's exactly right. Look at this resistance point. If you go across here, you will see this is 80. So selling in front of 80 would probably make sense because that's your little area that would be a problem. How about LinkedIn? LinkedIn is interesting because I hear a lot of sell-side guys saying they're finally figuring out their stock. That it's not just Facebook's stepson or stepbrother or ugly sister, but it's actually a viable company that is making progress, and sorry for those analogies. They're saying it's like an HR play, that what they're doing moving forward is going to be very important for business, for hiring, for HR, and an advertising play. And if you look at the chart, it looks really good to me. You go to LNKD, you'll see that I've talked about this many times. I talked about this last time. I wanted to be a big buyer when it broke above resistance here about 95. Remember that Goldman upgrade? They upgraded it. You could have bought it here, bought it on the retest, and now it's right back to those IPO highs. So once you get above those IPO highs of just say, let me show you a little close, above 120, there's no memories. It could go anywhere. It can go 140, 160, 200, but the problem here is earnings are on Thursday.
Right.
Last quarter they came out, they were strong, stock was up like $10. If they have a strong report and good guidance and can show consistent earnings like they did last quarter, I think more institutions will get involved, and I think this stock will be above 122 and at some point could be a $200 stock within the next 1 to 3 years. I'm risk averse. I'm not going to take this stock long into earnings, but I will buy some calls. I already bought them yesterday, but just know 90% of calls go worthless. I'm just doing it to be involved because macro guys are involved and it's my place, so I might as well be. I bought the 110s, and if they don't report well, they'll be worthless. But for me, I know my risk. It's defined.
Not enough history for me.
Yes,
so,
exactly.
You know,
So for institutions, that's why they want to see, another quarter. They
Yeah.
want to see stability. They want to see them come through. So for an institution, they want to see another report. There's still a lot of shorts in there. So if they report Thursday and it's good, I think that the stock could be up $20.
And let's end with JP Morgan.
JP Morgan, it's been trying to sort out the big move that it's had. I've been trading it back and forth. It had a little problem with 44 yesterday. That was a recent resistance. If you take a quick look, JP Morgan's been an unbelievable vehicle. I know, Stephanie, you've been all over this on the buy side. Same thing here, riding it from I think you were in the low 30s. And now, you had a big move. It's been digesting it. It's above the 50-day. This I drew yesterday saying I hope it gets through 44 and starts to get back in motion. That'll be great for the financials. Didn't quite get through there with power, but I think the market's not sure that they want to let the financials continue yet. So I think watch 44.20 as resistance. I think Bank of America looks pretty decent right now too. I know, it's not the best fundamentally, but look at this area right here. It starts to get above 840. I think this thing could hit 870 pretty quick.
And we're actually in JP, but we're also in USB, which I think had by far the most outstanding quarter of the group. So if that one were to come down, that one would be an interesting buy.
I'm going to put up that chart because that was something you brought to my attention. This is a regional, right?
Yeah. I mean, and most people say it's a boring regional, but I'll take that chart.
Yeah, this chart looks better than JP Morgan. Look at this breakout, nice tradable breakout yesterday. Tried to push through, didn't have enough juice, but this stock is at highs of the year where there are no other financials, whether it's JP Morgan, Wells Fargo, Goldman Sachs, Morgan, none of them at the highs of the year. So USB obviously was one to go with. Again, like your style, where it's not the crowded trade, it's the quality trade.
Absolutely, and I can sleep a little bit better.
So with that said, I think the thesis we get from here is that you could be involved with the market with a plan, be balanced. You're not going to necessarily be in the fastest moving stocks at all times, but there are stocks that you could buy in the base, stocks that break out you could add to, and then maneuver. And be in a bunch of sectors. Don't be like a mutual fund with like 100 stocks, but I would say be with 6 to 8 stocks that you know very well. For me, I'm in like 6, 7 stocks, and I'm having the spiders as a hedge because there's still some headline risk. So if all of a sudden we come in, the futures are down 7, 8, 9 handles, I'm safe with some spiders. And then if the stocks continue to act well, you could add, and that's how you manage your positions from a trading aspect. And from a portfolio aspect, you probably just do it a little bit broader.
Absolutely. We have 30 names, and it's the same premise that you're talking about. It's quality, it's diversification. We like a little yield too, and so for a little income, particularly since bonds give you nothing. And we're quick to take profits, but then we're really quick to buy it back. If the valuations, this market, it's pretty volatile on days, and so you can take advantage of it. And so that's why we have some cash and we're ready to put it to work.
And there you go. So if you want, tune into the recap every day. I wrap up the market, talk about what worked, what didn't, what we're going to look ahead. That's also on Real Money Pro. So hopefully you get a lot of value here. And if you're watching the show, I think you're taking the right steps to better yourself and put yourself in a position to win, because the market can make you money. You don't always have to be the guy that buys at the top, sells at the bottom. Let the market work for you.